Welcome, you tune into India Tonight. I'm Ankita Saxena and with me is Sumita Karir. And the top of the news today is that the International Monetary Fund has raised India's growth forecast by 0.2 of a percentage point to 6.6% for the 2025-26 fiscal year, as the country's strong growth momentum is seen offsetting the impact of high US tariffs on Indian goods. Isn't it, Sumita?
Absolutely, Ankita. So that's the big story that we're going to be discussing on the show tonight. We'll have a stellar panel of guests also joining it. But let me delve a bit deeper into what the IMF said. The IMF essentially has lowered India's growth forecast by 0.2 percentage points to 6.2% for the next fiscal year. That's essentially what the IMF stated in the report that it released in Washington just a short while back, followed by a press conference. Now, IMF's upgrade comes a week after the World Bank raised its India growth forecast for 2025-2026 to 6.5% from the earlier 6.3%, while trimming its projection for the next fiscal by 20 basis points to 6.3% due to US tariffs. In fact, ladies and gentlemen, before we go on to our guest who's joining us tonight, let's listen into what exactly the IMF had to say a short while back on the growth projections that it has for the US economy and the fallout of that on the world.
So overall growth in the U.S. has remained fairly good. It's slowed down from 2024, but it's still about 2% in our estimate for 2025. But the place where you can see that reduction in the labor supply is if you look forward and you think about what is the potential growth for the U.S. And that estimate, of course, is very imprecise, but our estimate of potential growth in the U.S. has been revised down as well, and that's reflecting that lower contribution from foreign labor force that was quite significant in previous years, and we're not foreseeing that it will continue to contribute. Now, the other side of this is what does it do to the rest of the world? Well, obviously, if you have slower growth in the US, per se, it's not a good thing for the rest of the world. There are spillovers that are coming from when an economy like the US is growing strongly, then it generates demand for other parts of the world as well. So something that is contributing to a slowdown in US growth is, in general, not something that is going to be good for the rest of us. The growth in the Chinese economy in the last few years has been coming in significant part from the external sector. But what we are seeing there is something interesting, which is we see an increase in volumes that are being produced, but we see increasingly a decline in the prices at which they need to be sold on markets. And that suggests that somehow the market has a limited capacity to absorb all of that is being produced coming out of China. And that suggests that that growth engine, that second growth engine itself is starting to face difficulties. So our advice to the Chinese authorities has been for some time now, it's been for many years, if you look back at our Article 4, there is a need to rebalance the growth model towards a sustainable domestic demand.
So that's IMF for 2025 Global Outlook. But let's go across to my colleague Anurag Joshi, who's also joining us with more details.
The International Monetary Fund has raised India's FY26 GDP forecast to 6.6%, while cutting the FY27 economic growth view to 6.2%. The IMF has put India's FY26 consumer price inflation forecast at 2.8% and the FY27 at 4%. The IMF today released these numbers for India and rest of the world and the various countries and regions. The IMF has predicted that the global real GDP growth at 3.2% for 2025, and that is up from a July forecast of 3% and 2.8% in April. That comes after Trump imposed global reciprocal tariffs and a tit-for-tat escalation with the Chinese government ensured. The IMF said that the global growth is at 3.1% in 2026, and that's unchanged from the July forecast. It projects the UK growth at 1.3% and UK inflation at 3.4% this year and 2.5% in 2026. UK growth is forecast at 1.3%. The Chinese economy still has to get over the impact of the property sector. According to the fund, the China's property sector problem is still not resolved. And the last 5 or 6 years, the global economy has been hit by shocks. And the Chinese economy needs to rebalance to sustainable growth demand in the country.
All right, so those are all the numbers that IMF has come out with. But let's get on board our guest for tonight. Gaurav Gupta is the Chief Economist, IDFC First Bank, and R. Gandhi is the former RBI Deputy Governor, International Monetary Fund, RBI Governor, who's joining us now to weigh in on the commentary that's come in from IMF. Let me come to you first, Mr. Gandhi. International Monetary Fund has now raised the global growth outlook to 3.2% versus a July estimate of 3%. Now, IMF cites easing of US-China trade tension as being the reason behind the growth outlook upgrade. Is that being a little too optimistic given the fickle and volatile Trump's tariff rhetoric that how it has been? And because, this refuses to doubt on just now, China has imposed sanctions on 5 of South Korea's Hanwha Ocean's US subsidiaries. So this is unlikely to wane off as of now.
Thank you. Yes, one point on the face of it, IMF sees that quarter by quarter when they have come out with this outlook, they have increased the global rate from 2.8 to 3 to 3.2. So that is on the positive side. But the narration which they have given in the report, that is quite a little contradiction is there in the sense that the impact of Trump tariffs and the trade related issues can impact the economies. That is what they are saying. Whereas in terms of numbers, they are projecting higher growth for the whole world. So that is one. The point about is that, yes, we have to be cautious about likely impact of the uncertainties relating to trade tariff. That is well understood. That's why they are cautioning about that. So when you say that they are optimistic about, that is based on the model. Model has predicted these numbers, so they have come out with those numbers. But qualitatively, they are giving a caution that tariff-related uncertainties we have to watch out for. It is a kind of balancing out.
Right, Mr. Gandhi, since you make that point, let me also take this question across to Ms. Gaurav Gupta. Ms. Gaurav Gupta, the IMF has given an upward revision this year. However, there is a minor revision for next year. What really explains that dip, and what will that be triggered by?
The downward revision for next year is basically, it's the impact of the tariffs. Tariffs will, for example, one of the reasons why they had to revise up their 2025 estimate globally is because there has been a lot of front loading of exports to the US ahead of the tariffs. For example, if you look at India itself, our exports to the US January to maybe as late as July was averaging at 24-25% growth in nominal terms. And then from August onwards, we saw it slow down to 7% growth for India's exports to the US as the tariffs on India started rising to 50% by the end. And now once we get more data, we'll see further slowdown in the second half of the year as the 50% tariff becomes imposed, effective for India. Similarly, for the rest of the world, we saw a massive front loading of exports to the US by all countries, by all Asian countries also. So that has actually limited the negative impact for 2025. So in a way, we will see the full impact of the tariffs in 2026. And that's exactly what the IMF trajectory is showing you. So you have a stronger growth situation for 2025 and the full impact of the tariff is in 2026, and you have a downward revision for the US. So that is what their trajectory is showing you. The fact that in 2026, we will no longer have that support from front loading of exports to the US. And you'll actually see consumer demand in the US becoming even weaker because the job market in the US is at its very nascent stages in terms of weakness. We just had a couple of months of really bad data. And I think it's been very recent that the demand for jobs in the US has become lesser than the supply. And the full brunt of a much weaker US labor market. Also, there will be an adverse impact on US companies themselves from the tariffs. All of that will be more a 2026 story. So that's what the IMF forecasts are actually showing.
That the actual impact of the tariffs will actually start being visible in 2026, and because you mentioned there has been a front loading of exports for now, the real picture will really be painted in 2026. But you know what, we were also expecting an earnings recovery as far as Indian companies are concerned, because our earnings for now till now have been very lukewarm. So going ahead, now that the tariff impact will start showing next year, can we not expect an earnings recovery? What is going to be, in that sense, the way forward for the markets? Because we have seen very benign moves.
You're asking whom?
Gaura.
Oh, sorry. Thank you. Earnings recovery, okay, so the impact on Indian companies will be more, again, it will be felt more in the second half. The 50% tariff on India was also effective from August end. So the second half of FY26, the full brunt will be actually seen in the FY27, where, in terms of our exports to the US, and it will be more for MSME. So let's say domestic oriented companies might still be better off, the ones that are servicing the domestic population, domestic consumption. But the companies which are more export oriented, and especially the ones that are more dependent on the US, yes, the impact could be more adverse in FY27. But our expectation is, as you said earlier, this tariff is a very dynamic I would say dynamic situation. I mean, just now, for example, while the IMF has upgraded 2025, the US has also increased its tariff on China, and there has been an escalation in tensions. So we won't even rule out de-escalation. So, for example,
Absolutely,
for us, we still believe.
Right.
So we still believe for India that the tariffs on India could come
That's
down.
That's a very valid. Right. That's a very valid point that you've made, Gaura. But let me go to Mr. Gandhi. Mr. Gandhi, let's take on from the point that Ms. Gaura has essentially mentioned about the elevated tariffs and, of course, the recent developments that have been happening as far as the US is concerned. It has put some additional tariffs. These are sector-specific tariffs. And then, of course, there is a trade war that could brew with China. Give us a sense of how much will these elevated tariffs have an impact on the global growth?
See, that's what I said, that despite the tariff announcements which has happened from the year beginning, or even the last the moment he took over administration, despite that, global growth has been seen as growing. Their predictions are, their forecast is on that basis, because the nearer term, the data is a very firm data, so they're able to upgrade it. But well, into the distant, 1 year later, how the tariff is going to be there, and I think they are looks like they are very conservative in terms of assumption being made. So that is what is happening. Now, how India is going to perform? Yes, definitely. I would think that based on the resilience that the internal consumption demand or domestic demand is going to shape up, that will give IMF in the next round, when they come out with their forecast sometime in January, they will be able to factor in that. That will bring in greater confidence in Indian economy. So India, for long, has always been depending on domestic growth rather than export growth. Export is icing on the cake, definitely. That is definitely there, but it has got internal resilience, and the alternate market research that is going on, and the way the trade talks with the US is also progressing. That can also be a positive factor by the time the next review comes, and we have a good understanding and agree on between US and India, whatever tariff.
Right.
That will be possible.
Right. Okay. Gaurav, Laura, coming to you then, Indian markets have been underperforming this year. In fact, we are the most underperforming markets. And it's, despite the global liquidity that has been induced, the consumption boost given by the RBA, the government is working towards it. The fact of the matter still remains that the FIIs are still net sellers of Indian markets. Now come next year, when the tariff impact starts showing on India's growth story, are the FIIs not going to return anytime soon? And also with the higher tariffs on India as compared to the other economies, other emerging economies.
So just to complete my point that I was trying to say earlier, so we shouldn't be too bleak for next year. Yes, the full impact of the tariffs it's going to be felt in next year rather than this year. This year we've got saved with the front loading. But the thing about Indian companies is, and people in general, is that we adapt to situations. For example, when the COVID shock had also come, there were very negative outlooks on growth, and the actual situation was not, in terms of economic outcome, was not as bad because individuals, governments, policies, we all adjusted. For tariffs also, I mean, it's very possible that companies adjust. They still find a way to reach the US market via other countries. For example, right now, you're already seeing China make that adjustments. So China's exports to the US is coming down, but their exports to other Asian countries is going up. And US is still importing overall. Their imports from China might have gone down, but their imports from Asia has picked up. So you could also see next year, Indian companies also, taking part in that whole value chain reorganization. And as Sir mentioned, that we are a domestic demand economy. So whenever we have these sort of situations where external growth is slowing down, economies which are more domestic demand tend to do better, and India is one of them. And as you mentioned, the fiscal stimulus, the rate cuts from RBI, all of them are aimed at boosting domestic demand when we have so much uncertainty on the export front. So we do expect some improvement in, let's say, the growth momentum, but definitely the tariffs at a 50% can't sustain. We'll need to see them come down to 25%, which is our base case expectation. So we do expect that the next year outlook may not be so bad, assuming that the tariff situation with India from a 50% reduces to, let's say, a more sustainable 25%. And also the fact that companies tend to, adjust. For example, supply chains, there could be changes. Also, how we do domestically also will depend. For example, right now we're getting fiscal stimulus, which should help us in Q3, Q4. Again, the jury is out how much of domestic demand recovery will sustain into next year. But let's say the urban wage growth revives, then we could see a self-sustaining domestic demand-driven recovery. But yes, right now I would say a cautious outlook, but we don't need to be too negative because companies tend to adjust.
Right. Absolutely, Gaurav. That's essentially what the view has been from several segments that India is not really an export-dependent economy. We are more dependent on the domestic demand that we have. And of course, the government is giving to several policy measures, and which is why there's not much need to worry. However, that having said, there's going to be a minor downtick as far as India's growth story is concerned. Let me come to you, Mr. Gandhi, and essentially talk about the overall global economy. I mean, if you see the past few years, the environment in which the global economy has been, has been hit fairly by seizable shocks. For example, there was COVID, then there was a cost of living crisis, the impact of military conflicts across the world, and now trade tensions. But what do central bank governors and chiefs need to do to remain resilient in the face of these several challenges and disruptions that we're seeing across the globe?
Of course, the growth prospects for the world economies, that has been, at least as per IMF projection, next year, it is going to be a little muted. Several jurisdictions are going to clock something like from 10 basis point to even 80 basis point kind of difference is going to be there, including China. That way, all central banks will certainly be looking for bringing stability in the market, that they would want to support their respective jurisdictions' economy. So when the inflation, as of now, inflation forecast has been benign that throughout the world also. So that will give some ample room for the central banks to have appropriate monetary policy actions. That will be there will be room for them to support growth. So that's what I would expect in the coming year because growth is muted. Inflation is well under control in several jurisdictions. That would give some space for monetary policy in the world to be more growth-oriented.
Coming back to Gora, what you said, you mentioned that perhaps domestic-facing growth or domestic growth is going to perhaps offset some of the impact that US tariffs might be coming in with. But Gora, what are the sectors then that will be leading the next leg of rally, or the sectors that will be contributing to this growth?
So from a very macro perspective, we are already seeing in Q2 that the agriculture, rural demand. So any companies that are catering more to rural than urban, they will get a sort of a fillip. For example, the rural-based indicators are beginning to show a good pickup in Q2. We are seeing tractor sales pick up. We are seeing a decline in demand for jobs under NREGA. Two-wheeler sales pick up. So rural, which was pretty muted, is now beginning to show signs of revival in Q2, which should sustain into the remainder of the year as the crop output comes, as this is the second consecutive year of good monsoon. The urban side, consumer durables, because of the fiscal stimulus in form of quite substantial GST cuts, we are getting, I would say we are still waiting for data, but anecdotal evidence for the bump up that we are seeing in, let's say, in a segment like car sales because of the GST cuts, and combined with the timing, the fact that it was beautifully timed with the festival season. So you will see some consumer durables, FMCG from the urban side could get a pickup in Q3 FY26 and onwards. Apart from that, the weaker sectors, as per us, which will require support, and we do think the government would be working on a support, would be MSME, because they are more, 45% of India's exports are MSME related. So that's one area where support will be required. Private capex is another area where support will be required because of so much uncertainty on exports and domestic. It's very difficult for private capex to really revive up. So, but there the support comes from government capex, which we have seen at least.
Absolutely. We've seen our government give that kind of capex push to the industry, but now it is incumbent upon the industry to sort of, give a private sector boost as well, which the economy has been waiting for quite some time now, and more so now, given the fact that the government has introduced the GST rate rationalization exercise. Let me come to you, Mr. Gandhi. Since we're talking about sectors, let me also draw your attention to the manufacturing sector of the country. It has grown in the past few months, according to what data essentially suggests. However, if the government is speaking about achieving a Viksit Bharat goal by 2047, manufacturing sector has to grow at the rate of 25%. How satisfied are you then at the pace of growth of this particular sector?
That's a tall task to grow at the 25% manufacturing sector. Because for quite some time, the economy has changed its colors more in favor of service sector. Our service sector of the total GDP, anything between, we have clocked between 55 to 60% of the growth, portion, the share. So the service sector has been growing very well. So in the for various reasons, the manufacturing sector over the past 2 decades or 3 decades, their growth has been muted. So suddenly to push up the growth in terms of reaching the Viksit Bharat objective or aspiration, it is going to be a tall task. So it's definitely government will be taking several measures, but we cannot grow that very fast, that very soon. So that maybe next decade, it should be possible to reach that kind of a higher growth. Yes, there's a PLI scheme, another thing which is specifically focusing on manufacturing sector. So that is bringing in quite a bit of visible growth. But by and large, throughout the country, for the manufacturing sector to grow, we have to see several other measures. Even today, the capacity utilization of the established capacity, it is ranging around 75 to 76, 77% only. That means that still there is excess capacity available. So that is what is holding back the private sector to expand in a bigger way in terms of manufacturing sector. So it will be a very conscious efforts will have to be there. That high growth in the short term to 3 years, we may not be able to clock.
All right. Thank you so much, Mr. Gandhi and Gaurav, for joining us and weighing in on the IMF projections. We'll let you go on that note, and we'll move on to the earnings corner. Well, while Indian earnings have also started, we will first look at the big bank earnings coming in from the Wall Street. 4 American major banks like JP Morgan Chase, Citigroup, Goldman Sachs, and Wells Fargo, all of them have reported rather strong set of earnings in Q3. JP Morgan's earnings beat the street estimates as the lender recorded a rise in profits in the third quarter. Now, the trading division gains and recovery in investment banking fees gave it a boost, and JP Morgan also revised its interest income forecast upwards for the year. But let's move on to the next one. It wasn't just JP Morgan, it was also Goldman Sachs reporting a robust gains in investment fees. The figure, in fact, jumped 42% on a year-on-year basis to $2.6 billion, about $500 billion higher than what was being anticipated. Now, the lender's profit rose 37%, while the revenue was up 20%. Both profit and revenue also beat the expectations. When it comes to Citigroup also, it was a good Q3 for them as well. Higher revenue across their divisions aided the company in the third quarter. Revenue of trading and market segment particularly stood out this time round. It was the best ever third quarter for the market segment, and trading revenues that rose 15% on an annual basis. Profit, meanwhile, also increased 18%. Also moving on to the next bank, Wells Fargo, that's profit also saw a jump up and beat the street estimates that came in higher by 9% on a year-on-year basis at $5.59 billion. Now remember that this was the first full quarter that the bank was free from the asset cap play that the Federal Reserve had placed on it. In fact, going forward, the company hiked the target for its key profitability metric too. So that's the roundup of all of the big banks posting the numbers. So good, seem good as far as the banking numbers are concerned coming on the Wall Street. We are also waiting big bank numbers for Indian companies as well, Sumita.
Absolutely, Ankita. So that's a comprehensive overview of what the earnings are essentially looking like if we look at American banks. But time now, viewers, for us to slip into a very short commercial break, but lots more coming up on the other side. You don't go anywhere.